Um, so I think largely, I think the early stage, did I cover that okay? Anybody have any questions on the early stage companies? And again, sadly, I don't have a magic formula that says, here's what it is. I mean, when I look at prices that some of these guys pay, I think there's an aspect of they throw a dart and roll a dice. Um, think about a number that they think is a fair number because there's no revenue, there's no earnings yet. Um, and they think about what they think of a return and what they think largely the next person's willing to pay when they ultimately get out. Um, I mentioned that one of our clients right now is investing in Snapchat. I honestly had no idea what Snapchat is. I'm clearly too old. I had to go ask my staff what it is, why I would want to use Snapchat versus email. I don't even know how to text. So I guess I'm old. Okay, so I learned what it was. I'm not sure I get it, so I guess I am old. But at the end of the day, I was reading the paper and I saw an article that the Snapchat CEO is speaking at a conference and said that there is essentially a tech bubble and all this stuff is overvalued and we're trying to go public. And then in parentheses, before the bubble pops. I'm like, great. My job just got a whole lot more difficult because now I have to come up with more documentation on why I think that the next quarter's valuation for this fund is okay. Because the owner of the company says there's a bubble and I'm living in a bubble and I got to sell before it pops. I'm not happy about that. Not much I can do about it, but it makes my life a little bit more difficult. And, there are a lot of articles, regardless of when you look at any financial, show or publication, that somebody's always saying the market's overvalued, somebody's always saying the market's undervalued. And, look, it's all of our job to try to discern what we think is fair, but largely it's as of what's happening today. And, if the FTSE index is up 5% today, it's hard to say that investors think the market's overvalued because they're clearly putting money into it. But again, it's our job to look at all the different factors that go into creating value and determine whether it's the overall economy, the industry, the performance of the company, the outlook of the company, the outlook of the technology that underlies the company's thesis. What do all of those look like? And come to a conclusion of up, down, sideways, and then try to quantify that. And so for early stage, it's harder. For a developed company, it's much easier. You can look at, multiples of revenue. You can look at multiples of EBITDA, book value, tangible book value, tower cash flow, whatever metric is appropriate for your industry. It's not that difficult. In some industries, there's a ton of comparable companies out there that give you great indications of what investors think of that industry, that sector. And it's very difficult to get by that if you're, supermarkets. There's a bajillion, publicly traded supermarkets that all trade in a very, very tight range. It's hard to say if, what that investor sentiment's the opposite of what you see the market for those companies is doing overall. Largely, for more developed companies, you have established cash flows. As the company gets more developed and has revenue and or has earnings, and as those earnings and become more stable or more predictable, a discounted cash flow becomes much more relevant and much more reliable as a basis of your analysis. I think one of the things that might be interesting to you is that if we look at funds, there is a greater level of volatility for funds that use a market approach only to mark their books than those that use a discounted cash flow analysis. The reality is when they have a 5-year discounted cash flow analysis, what happens from quarter to quarter doesn't make a big difference in the ultimate value ascribed to the discounted cash flow. And so weighting them, it doesn't have a big change, and therefore the discounted cash flow analysis tends to mute any volatility for that investment, which is interesting. More often than not, we often think, what does the fund have available for us to look at and to work with? I think it's interesting to think that's a factor that people should consider. Sometimes it's available, sometimes it's not, but it's something that does happen, and you may notice it. Yes.
A quick question on valuation from bankruptcy point of view, in the sense, if some of these .coms or some of these retailers, online retailers, are spending cash or are kind of burning cash, there would be a finite life that they would be able to live.
Yes.
And the fundraising, the next set of fundraising needs to happen. What you mentioned earlier is that if the fundraising is in the plan, then the value goes up. But the fact of the matter is that that fundraising is something which they'll have to do continuously if they want to continue the business model that they have.
Yes.
So how do you deal with that?
Well, I won't necessarily say it will go up, but if they expected it, at least means that there's a lower probability of unexpected dilution, which means it won't necessarily go down. Look, I think we don't necessarily think of it as, is there only one more round of financing? Right. There's always a conversation of, is it one more? Is it 5 more? How close are they? And again, that gets back to the milestones and understanding what their expected timing are for different things. A lot of, retail.coms, they don't have many assets. So if it blows up, you've got nothing left in bankruptcy. What was it, pets.com, the little sock puppet? I think they ultimately did sell the little sock puppet, but that wasn't a whole lot to go on there, and I don't think I've seen the sock puppet in a couple years now. But so we do think about it, and we look at, we'll weight the probabilities of more and more future rounds. The less well that the company's performing per milestones, you start putting more weight on the fact that they may need another round. One of the topics that we've been thinking about a lot lately is that if you look at the Ubers, the Alibabas, the Snapchats, an awful lot of investors in these companies, while they're more mature, they're still largely unproven business plans. Snapchat has a lot of users, but they've even say in kind of their public speaking, they don't really have a model for generating a lot of revenue yet. Right. There's not a great advertising model there today. How will that change? But what we see is a lot of investors are looking at it more on a fully diluted basis than they are on a liquidation preference basis. And when is it appropriate to switch from, we're not sure about this, and more of a, downside scenario, to saying, okay, we think this is more proven out, and maybe we should move to a fully diluted basis. That's a little bit more of an optimistic view. And there's a lot of moving parts to it, and I think there's no black and white answer. If it was, I wouldn't have a job. We could automate it and it'd be very easy. None of you would have a job. It'd be very easy. So we should all be happy that it's difficult, but it is kind of putting that mosaic together and saying, look, if I look at all of these pieces, what do I think? And look, I think from my experience doing valuations, which frighteningly is over 20 years, it's hard for me to think I've been doing something for that long, but I have. That the bulk of the time when you do an analysis, I think the sort of back of the envelope first pass that you have before you really dive in and document all your assumptions and prove everything out, that first pass is usually 95% right. And so, your gut's actually pretty good, or mine's been pretty good. If I trusted it more, I'd be the investor and I'd be retired by now, but I don't. So don't invest as I do the opposite. But you do have to think about all those factors and consider it. And, sometimes you'll be right, sometimes you'll be wrong. But again, if it's not doing as great as you thought, it may need another round. It may need 2 more rounds. And that's, again, what did you expect?
So would it be fair for me to say that last time when we had the tech bubble, it was the NASDAQ and the listed space, which we saw the brunt of the rise, the rise and the brunt of the fall. This time it's going to be the private equity guys who will probably experience it in their portfolio. You may not see it in actual
Right.
world.
Which is good for the rest of us. Unless you're a pensionee, in which case your money's gone. But I'm sorry. I don't have an answer to that. I think it's an interesting challenge. Hopefully it doesn't ripple out to the rest of us too badly. I've seen a few different articles, and clearly that will create some liquidity issues for these funds. It will not be great for the investors, but most of the venture funds or private equity funds have not been deemed, to be systematic risks to any one economy. So hopefully it doesn't cause too big of a ripple, but the markets are the markets, and you never know what they'll do from day to day. So yes.
As an independent valuer, do you also run the risk of getting influenced by the approach that you take in terms of valuing the company, guided by the PE funds and the way they want to value you? I mean, the way they would like you to value the company. So what exactly I'm trying to ask is, now Amazon after 25, 26 years still is not a profitable company, right? So ultimately, the valuation also is boiling down to the fact that it's a bigger fool theory rather than any classic traditional way of valuing the company.
Yep.
So for these kind of companies, and ultimately you as an independent valuer are also kind of valuing it similarly as the way the PE guys would be valuing them. They have different compulsions in terms of valuing, because if there could be that the driving factor could be the first mover advantage and creating the barriers by the flood of capital and the burning capability of the company, which may prevent the other business models to come in. But as a independent valuer, how could you subscribe to that same methodology?
So look, I think at a high level, we tend to look at the same theoretical approaches to value. I mentioned cost approach, income approach, market approach as somebody else. I have a wonderful luxury that as an independent valuer, I'm part of the largest firm in the world that values private companies as an independent valuer. As such, no one fee matters to me, and that I am not going to impede my independence for any one client investment. That if I think it's wrong, I'm very comfortable saying it's wrong. I think from experience, what we see is that there are very few venture guys or private equity guys that do not have tremendous egos. I don't necessarily mean that badly, but they tend to be very self-confident and have pretty strong egos. They think they're right. They put their money where their mouth is. These investments are their babies. They take them very personally. When they're not doing well, they take it very personally. It's emotional and financial distress for them. So they don't like to do it. At the same time, they are, as being very confident, one might liken them to a little bit of the bully on the playground, and that as the independent valuation guy who's not the deal guy, we are the geeky kid on the playground, the skinny little kid that they like to pick on. And sometimes they just like to pick on us to see what we'll do. And they may know the value went down, but they'll say it went up just to see what we'll do. And, in our world, look, it's not easy, and I hear many, many stories from many funds about some other firm that they used that they just felt rubber stamped whatever they gave them, and that's why they're getting rid of them. We've become very comfortable that we know what we're talking about. We see a lot. We work with a lot of asset managers. We know their general mentality, what they're thinking. We know what the general market sentiment is for the space that they're in. There's very few sectors that we don't see a lot of. And so it's pretty easy for us to say we know what participants in that market are thinking. And if this person's an outlier, it's actually relatively easy for us to call them out as an outlier, and for us to really provide pretty good, solid documentation as to, we think you're wrong and this is why. I'm very willing to say that these people live with the investment 24/7, and I come in quarterly or annually to help them out. And so I'm not as in touch with it day to day as they are. But at the same time, I have that critical distance, and I'm comfortable saying, this is what I see, this is what I know, this is why. I have the opinion that you've overvalued this company. 9 times out of 10, they go, okay, you caught me. You called me on it. And they'll change their value. Sometimes they say, you know what, did you think about this? And they'll give us a new piece of information. Sometimes they'll have forgotten to give us a piece of information that's important, that they just had an oversight. So it definitely happens. You know, people definitely test us. And again, I'm very comfortable that we have the experience and the knowledge to push back appropriately on people. We don't do it just to say, oh, you know, we haven't bugged this guy in 6 months. Let's bug him today. He's due. You know, we pick our battles, and that gives us a lot of credibility. And when we call a CFO and say, look, this deal guy isn't, you know, being reasonable, the CFO ultimately is the one who has to sign off on things, and they help us resolve the problems. So I won't say that it never happens. I'd say the other thing that we occasionally come across is we'll see the same investment held by 2 funds. One will market at 80 and one will market at 20. And they both have the exact same information, and one just is bearish on the investment and one is bullish. That's what makes a market. That can be a great thing. That said, for me as the independent valuer, we're stuck in the middle, not such a great thing. Generally, I'm not real happy when that happens. What we've found is that, you know, what we often do now is we'll tell client A, if you really think it's worth 20, do you want to sell? Because I know somebody that'll pay you more than 20 for it. We'll go to the guy at 80 and say, if you really think it's worth 80, I know a guy who will take something less than 80 for it. And that produces some interesting conversations because they know that we have the client base that we have. They know who our clients are. They know that if we're bringing it up, it's a credible threat that we're willing to make the introduction. And, you know, again, most of the time that resolves the issue. That, you know, we have had clients say, I would sell at 21. If you know somebody who'll give me more than 20, I'll take it. Introduce me. I've also had people say, you got me. And they'll move it to 50 or whatever the number is because they were just testing us. So again, we've come up with multiple ways to try to solve the problems and bridge the gaps across different asset managers. Again, sometimes they're just having fun with us. It's not always fun, but they like it. So, okay.